Hi there, I'm Peter Russell from SuperTax. Welcome to another one of my video blogs. Today's discussion is going to be on the TFSA account here in Canada, a brief and general understanding. The TFSA account is also known as the tax-free savings account. Now, what exactly is the tax-free savings account? Well, it's a tax-efficient savings vehicle available for eligible Canadians. Now, how do you become an eligible Canadian? First of all, you must be a Canadian resident. Secondly, you must be at least 18 years of age. And third, you must have a valid social insurance number. Now, in essence, the TFSA account, with the TFSA account, any income earned within the TFSA account, such as interest, dividends, and capital gains, is not subject to income tax, or in other words, it's tax-free. Now, how does this differ from an RRSP? Well, when you make an RRSP contribution, the RSP contribution is generally deducted from income to help determine net income for tax purposes for your Canadian individual income tax return. This will help reduce income taxes payable and can develop into an income tax refund. The RRSP contributions and income earned within the RSP is tax deferred until the time it is withdrawn. Now with the TFSA, the income earned is tax-free, but you cannot deduct the TFSA from your income to help reduce income taxes payable. That is the main difference. Now, what type of investments can go into the TFSA account? Well, you've got things such as GICs and term deposits, bonds and mutual funds, and stocks and companies. Now, there are some investments which are not allowed in a TFSA, such as you cannot hold a mortgage within a TFSA, or you cannot hold shares in which you own 10% or more of the company, such as if you had a Canadian-controlled private corporation which you were the sole owner, and you say you owned 100% of those shares, you cannot put in a portion of those shares into your TFSA because you own 10% or more of the shares. That would not be allowed. Now, what are some advantages of having a TFSA account? Well, TFSA accounts are very good for emergency fund savings. They're also very good for saving for things for the future, such as a new automobile or for savings for your future education. Now, if you have a family, it's very good for income splitting. So let's say, for example, there's a mom and dad and 2 kids, and each of the kids are over the age of 18. So everyone's eligible for the TFSA account. Well, if dad is the main income earner, say his income is $200K or more a year, and mom has nominal income, and the kids have nominal income too, but they all have TFSA accounts, dad can fund mom and the 2 kids to contribute to their TFSA account. Now, the income earned in those TFSA accounts are tax-free, and that income would not be attributed back to dad. Also, the TFSA account does not affect your eligibility of any federal income tested benefits, such as the GST credit, Canada Child Tax Credit, or the Guaranteed Income Supplements. Also, if you are a holder of a TFSA and you happen to die one day, and you have a beneficiary such as a spouse or a child, then your TFSA account balance can be transferred to your beneficiary tax-free. Now, if you decide to become a non-resident during the year and you continue to contribute to a TFSA account, you must remove those contributions after you become a non-resident, otherwise you will begin to be taxed at 1% per month on your contributions as a non-resident. Now, I want to talk to you about an example of how to calculate a TFSA contribution room and penalties, because this is sort of a hot topic with some of my clients, because in the last couple of years they've made contributions to TFSA accounts and they found they've made over contributions and have found out that they have penalties that they didn't understand about. Now, usually, how do we determine a TFSA contribution room? So for 2011, your contribution room is equal to $5,000 for 2011 plus any unused contribution room from 2009 and 2010 plus any withdrawals from 2009 and 2010. Yes, once you withdraw money from a TFSA, that amount is added to next year's TFSA balance. Now, I'm going to show you an example here, as mentioned before. So we're going to go to my big board. Here we got a TFSA contribution penalty calculation. Now let's say in this example, let's say the person that's contributing, his name is Jim. Jim has, in 2009, a limit of $5,000. He decides to make a $2,000 contribution in 2009, leaving him with carry forward to 2010 of $3,000. On top of his usual 2010 contribution room of his contribution limit for 010 of 5,000, he now has 8,000 carry forward going into 2010. Let's say in 2010, Jim got a big bonus from work and they said, well, why don't you just put it all into a TFSA, you must have room. So he decided to put $15,000 into the TFSA in 2010. Well, he's over contributed $7,000, which is 8 less 15, giving you a negative $7,000. He is then subject to a penalty for every month he over contributed. Now, up here, I mentioned September 1st, he made the $15,000 contribution. So he has 4 months of over contribution in the year 2010. So we calculate the penalty as 4 months times $7,000 times 1%, giving you $280. He would have to pay that $280 by June 30th, 2011, or he would be subject to an additional 15% penalty on top of that $280. Now, in 2011, he's developed $5,000 more of room, so that eats up some of the $7,000. He's now over contributed only $2,000 for the 2011 years. Say he doesn't make any withdrawals, he just leaves it as is to wait to the next year to clear it up. Well, his penalty for 2011 would be $12 times $2,000 times 1%, equaling $240 penalty. If that penalty is not paid by June 30th, 2012, add on another 15% to that $240. So that's how the continuity of contributing to a TFSA works and if there are penalties involved in over contributions. Well, I hope you found this video on TFSAs here in Canada informative. If you have any questions or comments, please feel free to leave them below. Otherwise, you can send me an email to peter@supertax.ca. Thank you very much. Have a great day.